Howdy, Jacob here. Today we're looking at Chegg. They are in the diversified consumer services industry, 341 million market cap on 193 million enterprise value. They operate a direct to student learning platform. I remember in college, I definitely had some friends who were using Chegg for studying and then other purposes. But looks like they're in quite a bit of things that have to do with learning, higher education. That's good to see. Did it just say okay, US and internationally? Okay. So growth is over double revenue over the last 10 years. There was very substantial growth 2019, 2020, and 2021, and we're actually seeing slight declines in revenue. The operating margin and gross margin, operating margin hasn't really been very positive, but gross margin is at 70%. So if they can get operating margin in the double digits, this could maybe be an interesting price point. Their income statement does show quite a bit increase in R&D, 49 million in 2014 to 192 million in 2023. You cut that in half, you're looking at about 100. I mean, even over here, okay, interesting. So cut that in half, you're at 100. Increase that 100, I guess it's only 50 million, but over here, quite a bit greater on the margin side. So, I mean, we'll have to see what free cash flow is doing because that's going to give us a more direct story of cash in, cash out. But increasing R&D is usually a positive thing. You can't guarantee that it's going to create value in the future, but you are taking money away from today to hopefully create more money, an exponential amount of more money in the future. And then also, interestingly enough, huge decline of shares. Looks like they were increasing it pretty heavily and consistently from 2014 to 2021. But since then, shares are down a massive amount. The balance sheet has 136 million cash on hand, 194 million short-term investments, 357 million short-term, 243 million long-term. So they did just okay. Looks like they got rid of quite a bit of debt here, and the debt at 357, probably not a concern. They might have to sell off some of these investments, which might not be great, but they do have enough cash they pretty much have enough cash like products to write off that short-term debt, and then just 240 million in long-term debt, not a substantial amount. And they produce a good amount every year. So they might not even have to sell off those short-term investments, but it looks like they had some pretty big sell-offs here on the investment side. Maybe that's led to their revenue declining a bit because we did see 2019, 2020, and 2021, their revenue jumped up a lot and they made heavy investments. And here, the last 2 years, revenue's fallen and they've sold off some of those investments. So we're going to have to balance that when we do make our assumptions here. Majority of their cash going towards share repurchases, debt reduction, a little bit on the acquisition side as well. So I think we're ready to start making some assumptions here. On the revenue growth side, it's really sick. It looks very cyclical. You have 57% increase with 16% decrease. I think I'll probably meet somewhere in the middle, maybe 5%. And for margins, let's say I'm going to go off mostly free cash flow here, do a little bit of a range. So 15%, 20%. Share change. They have bought back a lot of shares recently, but let's see. If they produce $150 million, $150 million is a lot. That's like that's less than 3 times their price to free cash flow right now. So that's very interesting. I might just, I think this will be a very interesting company. So at 5% growth rate, probably 15 PE market average there. Share change of, I mean, even if, let's see. All right. So either way, I'm going to be looking at this company. Share change, I mean, they're going to be buying back shares. That's what they've done the last little bit. And that's a lot of shares. Okay. So Maybe there's something going on that I'm not entirely comprehending here. I mean, they're down humongous. They're down a huge amount from the peak in 2021. I'm gonna have to do more research here. The company makes $130 million a year. Oh, because of offset stock is compensated. Okay, so yeah, 1%, I'm fine. 2%, I'm fine with that. Anyways, the company produces a hefty amount of free cash flow. It looks like their debt has been heavily paid off since making some of those acquisitions. To where, I mean, they have 357 million short-term debt. I could see how that could be concerning if it's due in the next couple months and they haven't had chats of refinancing yet. But this will be something I just got to do a deeper dive on in soon because it looks interesting. I think if this debt situation gets figured out and they're able to keep $100 million of free cash flow, I mean, you're looking at a company with, they pay off their debt or they get it figured out. They have as much cash on hand as debt. 10 times 100 million in free cash flow, they should be selling for $1 billion. So, I mean, that's just raw math. But even based on my assumptions here, it looks very, very good. So we'll have to do some deeper dives, see if it makes sense, see if it's worth the risk, and everything like that. But I do hope you enjoy the video and have a great rest of your day. Thank you.